Hello, and welcome to this the next in the European Tax Register webinars. And today we're going to be talking about digitalization in practice, new opportunities and challenges for tax advisors. The speakers today will be myself. I'm chair of the Tax Technology Committee for CFE. Alberto Trabucci, who's a tax advisor and statutory auditor, and Felipe Correa, chair of the International Tax Committee for CFE. Now, what we're going to talk about today, I'm going to do a very brief SWOT analysis of where tax advisors are, specifically in relation to digitalization. Then Alberto is going to look at the EU Council Directive 14B, which is primarily about how you tax digital supplies and the problems associated with that. And we'll be comparing what the Commission has sought to bring about and what is happening in practice, specifically with relation to Italy. He will also be looking at the situation with the OECD, who have been wrestling with the same problem and the difficulties associated with that. Philippa will be talking about the impact of digitalization on businesses and chief financial officers, and also then the declaration of CFE on the subject. That's two separate but very important related issues. So I'm going to nip very quickly into SWOT analysis of the digitalization in practice and just look at where practitioners are, what they've got, what they haven't got, what the risks are. Well, what they've got is a strong professional background. They're used to professional discipline. They're almost certainly going to be computer literate. The extent of where that literacy is something that will vary, obviously. They're very competent at iterative processes, and that's sequential processes which will become increasingly important in the digitalization of tax. And they're also normally very, very good at client communication and supply of information and receipt of information. And those two skills are very important in looking at how data is managed, how it's supplied and how it's used. Weaknesses that they've got, well, they are primarily to do with the workload, I think, more than anything else. Technology is moving faster than most people's ability to absorb the changes that are going on, and that's because it's a horizontal move forward, and there are so many people looking at so many diverse areas that it's impossible to know all of them. That coupled with a sustained and consistent pressure of client work, and client work which needs to be done bearing in mind all the professional checks and balances that need to be put behind it in doing it. That is a consistent consumer of time and can, in many instances, be seen as a significant obstacle to looking at the issues associated with the whole process of digital transition, simply because when you look at what your client needs, that's a matter of priority. And so if you're going to be looking at doing something else, you may say, well, I'll need to do that tomorrow and I'll deal with the client's needs today. That may work on one or two occasions, but eventually, if that is the consistent problem that is there, then what is required is a short break away and to ask yourself in terms of strategy, what needs to be done? What do I need to do in order to solve this problem and enable to put myself into a situation where I can solve the problem. Part of the problem is going to be legacy systems, and I think it's fair to presume that those systems will change over years. Some countries will move quicker than other countries. Those countries that move slowly, then the traditional ways of dealing with tax affairs will remain consistent. The skills and the abilities of the individuals who deal with it, they will continue to remain relevant. But if you have fast changing systems, then apart from anything else, there is going to be a need to find out what those systems are, how you're going to deal with them, how your staff is going to deal with them, and what sort of technology you're going to need to deal with them. So whatever happens, tax advisors are going to need to make an investment in time, in systems, training and recruitment. And these are the same problems that revenue administrations are facing, and they are finding great difficulties in coming to terms with them. But if you look at those countries where they are significantly advanced in their Making Tax Digital programs, you will see that one of the major characteristics is that there has been a significant shift in the nature of the staff employed. There have been substantial redundancies in respect of those who may be getting toward the end of their careers without the wish or the ability to convert to new skills, whereas there has also been a significant effort put into training and the conversion of existing staff, as well as the recruitment and training of new staff. Opportunities, well, this is good news for tax advisors because digital is the future, and it's the start of a curve that is going to keep going because there's no slowdown on digital change. And as we go forward, it's going the complexion of what professional life looks like is going to change more and more and more. The professional skills that tax advisors have got, they will be usable very much to underpin client confidence and developing client technical awareness, which may be a factor of small, medium-sized business clients rather than the larger ones, because by and large, already larger corporations are having to deal with these issues themselves. And that is something that Philippa will be talking a little bit about when she does her session. At the moment, it's still relatively new, particularly at the lower end of the market in terms of size, no other. The possibility of getting involved in digitalization does provide first mover advantage in those countries where they are quite a way down the line in making tax digital. Those businesses, those professional partnerships or companies that have embraced and developed a strategic model based upon digital transition, they are now well and truly flying, and they're very much ahead of the curve. And one of the things that they pick up on is the fact that as digital comes on, there are going to be new and lucrative lines of business available, and their strategy says they want to be seen as a provider of those lines of business. Threats that they're going to have to face in those terms are that other professionals may seek to seize that space. That could well be software providers, it could be lawyers, it could be accountants who are not specifically tax advisors at the moment, but deciding to come in. And who knows, it could be that revenue administrations decide they're going to advanced the border of what they do to encompass dealing with clients as well. Certainly in terms of some aspects of making tax digital that I've encountered in discussions with revenue administrations, they would dearly love not to have tax advisors in between them and their clients. They would like to deal with them directly. The problem that they have and will always have is that there is no way that governments are able to supply the financial investment to develop a revenue administration that would be sufficiently large enough to deal with that. Certainly at the moment. In 20 years' time, who knows, there may well be the capacity to do that, because instead of using individuals, you're using machine learning to deal with everything. However, that is not something that is an immediate problem, because revenue administrations realize the big problems they've got at the moment, and COVID-19 has made things infinitely worse for them, because they've been taken off on one side to deal with all the other aspects of treasury requirements in putting funds and support to those people who need it, and they've been putting on the back burner a number of the things that they have had and were wishing to pursue in terms of their digitalization programs. So there is a bit of a breathing space that's been given by COVID-19 to tax advisors to begin to look at how they're going to approach the next 5 years, next 10 years, and to see what digitalization is going to mean to them and their businesses in that period. Well, that covers what is a very short but sweet, I hope, run through the SWOT of where tax advisors are now. And I'm going to hand over to Alberto, who is going to now go through a very significant issue associated with the professional tax changes that may be coming in the near future. So Alberto, over to you.
Yes, Jan, thank you. Let me share my slides. Okay. As you said, we just saw digital impact for our own activity. And now we move to a very short analysis of digital impact for our client, specifically from a tax standpoint. The first point I want to make is that during the last years, we witnessed a new value chain for digitalized multinational companies. The main characteristic of this new value chain is that it's easy to be conducted without a physical presence in other states, because the value creating refer primarily to algorithms and user data. The combination of algorithms, which can we say the IP of the multinational, combined with the user data given to the platforms, for instance, voluntary or involuntarily, creates the biggest value of the digital multinational company, because interacting the algorithm with the user data, it creates the value of being in a specific platform, in a specific web network. And this is probably the main point, one of the main points which require the tax jurisdiction to rethinking of taxing multinational digital companies. The second point that push tax jurisdiction to reevaluate the traditional international taxation criteria is that during the last decades, there has been an increase of use of international tax abusive schemes, in the sense that the fragmentation of the system, and the lack of multinational rules valid at worldwide level, plus the pressure that the enterprises normally have for competition. So in order to trying to lowering the prices of their products, together with the need of competition from countries that needs multinational companies to invest in their country, and so sometimes have been pushed to go into the tax competition battle, either decreasing tax rates or allowing some particular facilitation, either with explicit rule or with non-undisclosed ruling, facilitate, as I said, the increasing of international schemes, which main impact was lowering the tax due on international profit, especially from digital economy, because as I said, there is no need of physical presence in order to increase value in that type of context. In addition, the utilization of hybrid system, a non-coordinated system of CFC, render the systems vulnerable to this type of planning. In addition, massive of cash have been parked in foreign jurisdiction due to this lacking of coordination, and no repatriation were possible at the time or convenient at the time in order to avoid the subsequent tax at the level of the residents. And this caused that this huge amount of cash have been repatriated under the form of loan, which furtherly decreases the taxable base of resident company via the deduction of passive interest. That's put in crisis the traditional criteria for international taxation of digitalized multinational. In fact, the traditional criteria have been based on a bilateral, let's say, approach. From the one side, the resident country, from the other side, the source country. Differently, in order to correctly tax a new digitalized world, the perspective must be different, and we have to move towards a trilateral approach, because from the one side we have the resident state, where, for instance, the digital ultimate parent company resides. Then we have the source country, the old source country, which is the country, for instance, where the client that paying the services to the digital entity resides. And then we have a third country, which is the country where the users are. And as I said before, part of the value created by the digital multinational derives from the utilization of the user's data. And so the discussion starts in order to see whether the trilateral approach might be a solution to this, this issue. In addition to that, some ancillary reactions have been put in place by the OECD, suggested by the OECD and several countries. For instance, a new approach to transfer pricing have been put in place. Little by little, we are abandoning the transactional net margin method, which was primarily focusing on one side of the transaction, leaving all the rest of the profit to the other side, and leaving low margin to the, let's say, routinary function of the distributing company. Then have been suggested to react on the CFC side in order to strengthen the discipline of CFC rules. And then tremendous efforts have been made vis-a-vis the anti-hybrid provision in order to reduce the risk of mismatch between different tax regimes, allowing, for instance, deduction from one side and non-taxation from the other side, plus other cases. In addition, lack of transparency has also been addressed with particularly a couple of intervention, both from the OECD side and the EU side, with the DAC 3 and DAC 6 provision. However, having said that, coming to the main topic, which is the multilateral approach, the BEPS project, the 2015 BEPS project, started in 2015 and concluded a couple of years later, concluded that all these ancillary reactions, such as limits on the deductibility of passive interest, anti-hybrid provision, new GAR provision, new CFC strength and CBR transparency rules, etc. OECD concluded that mainly probably this reaction could have been sufficient also to address the problem of the digital multinational taxation, and so postponed the creation of a specific system to this sector to the future. After a couple of years, everybody now agreed that the issue exists. And I think now it's clear that all the parties agree that digital economy needs to be ring-fenced, namely needs to have an appropriate regulation. And this has been, let's say, started after the 2017 reform in the US, which after they foresee the change in the international situation, anticipated all other countries with a very in-depth reform, which I will talk about later on. The main issue when addressing the digital multinational taxation is where the value of this multinational is created. And here, two different approaches might be highlighted. From the one side, particularly substantially the US, which are saying the real value is the algorithm, is the IPs of the companies. From the other side, the market jurisdiction, including very often Europe, which is saying something different. The value created by the multinational digital companies is not only given by the IP, but is given by the combination of the IP with all the function which is called damper, which is all the routinary function, which is in the past have been considered routinary in order to develop and maintain an existing IP, plus, most important, the user data. Without the data that each user gives to the platforms, the value of the platform would have been zero. The value of the platform is given by the fact that they can, through the algorithm, manipulate and organize a massive amount of data. This different approach give rise to different reaction. The US in 2017 put in place a very strong tax reform, very aggressive. They strengthened the CFC in order to change the philosophy of the CFC from the old philosophy, which was an anti-deferral provision. They changed it in an anti-diversion provision, trying to attract to the US much more income parked abroad. And when the CFC will not be able to do it for all type of income, they introduce also a guilty, which is a kind of attraction of taxation for the low foreign income from IP. So to the extent a multinational group with the ultimate parent company in the US has foreign income from IP, to the extent this foreign income is not taxed adequately, it must be taxed in the United States, regardless of the fact that that tax basis might be under the jurisdiction of other countries. other minor, let's say, ancillary rules the United States put in place, but this is perfectly coherent with the approach. They believe that the value is the IP, and since the IP ultimately owned to the US needs to tax all the excess profit realized worldwide. Very different is the European approach. I will come to the European approach in a minute. First of all, I would like to talk a little bit about the OECD approach, notwithstanding the fact last month the discussion on the OECD projects have been suspended by the US. And so there is a little uncertainty on how the process will be supported and will go on again. Basically, the OECD approach is quite similar to the, it's kind of in the middle of between the US and the EU approach. They understand that there is a need to take a trilateral approach. There is the need to tax some part of the excess income in the country where the value is created, which is basically the market country or the marketing where the user data or the DEMP activity are carried out. And they are trying to do in a combined way through two pillars. With the one pillar, they assume an approach similar to the GILTI, and they are saying that although routinary function might be still remunerated under a transfer pricing point of view through the old and traditional method, the excess profit might be taxed. Part of the excess profit might be taxed in a country or in the market country where the users provide the data to the extent of certain ratio to be calculated at the group level. This is the most important news. It's a kind of revolution because for the first time in the world, there is a concrete approach which might lead to tax something determined at the group level. We are trying for so many years with the CCBT, but we know that at the moment we're still thinking, but there is no something concrete. Issue several: risk of double taxation, a risk to not considering specific situation. There is the risk, for instance, to mix digital company with no digital company, or maybe one company which carries out both typology of activity. Risk of enforceability. How can I calculate the taxable base in Italy if the consolidated financial account is made in the US, for instance? Second pillar, even more stronger, it's a kind of competition of the first one, and it also reminds something of the US reform. Basically, they are saying that when you receive an income, to the extent this income is not taxed at the appropriate manner, you apply a kind of minimum tax in the residence country, together with a switchover clause, of course, in the double tax treaty, namely, to the extent the income is not taxed adequately, you cannot apply exemption, you have to apply taxation with credit method. And the other approach under the pillar 2 is the contrary. When you make payment to others, so now we are looking at the source country, when you make payment to the others, to the extent the other does not tax that payment in an adequate manner, you might be taxed in your country. And of course, you have to add to this in the bilateral treaty subject to tax clause in order not to avoid the application of withholding in such a case. But again, the USA last month stopped negotiation, and so Mr. Gentiloni last week, let's say, make a revamping of the EU work on the topic, and so we are, let's say, facing maybe an acceleration on the work on the directive. Of course, the Europe started with the ATAD directive 2 years ago. All countries more or less implemented this directive in a very coherent manner. This directive includes CFC rules less aggressive than the US for evident reason. Europe is an importing digitalized economy, while the US is an exporting digitalized economy. Limit for deductibility of interest, passive interest, exit tax provision, anti-hybrid rules, and a general GAR provision. The directive is at the minimis. Each state can be more aggressive in combating abusive schemes. Last 5 minutes, I will talk a little bit about what is called the European web tax, which is not correct. We have a couple of schemes of directive that when the work of the OECD on Pillar 1 and Pillar 2, they have been suspended. But now again, I believe the work will start again after the suspension of the OECD work. And basically, the Directive 147 is a midterm, let's say, directive. It's focus on the trilateral approach. It's saying that there is a new concept of nexus. It's saying that you can have a PE also in absence, in the lack of physical presence, because you might have a PE in the case of a significant digital presence, which is given by certain factors, given by certain figures linked to turnover, digital turnover, and so on. After identifying this PE, the traditional transfer pricing rules apply in order to determine the income to be attributed to this PE. Ambitious projects, but I think very cool, because it gives a protection to the single European country to, let's say, move in a coherent way altogether. However, there is a problem. This will need to be done after, or at least it can be effective only in Europe. It can be effective outside Europe only after renegotiating bilateral double tax treaty. European community know that, and so prepare another scheme of directive, which is the 148, providing for a digital tax services, for a digital services tax, which has been due as an interim period tax in order to solve the issue in the meantime that the double tax treaty network is reviewed. Basically, is defined as an indirect tax of 3% on digital turnover. There are some categories to be taxed, which is not including the e-commerce. What is focused on the directive is the services rendered by the digital mechanism in an automated way. So e-commerce, in the light of the Commission at the moment, doesn't seem to be, let's say, characterized by the majority of the utilization of the digital premises. The Europe directive wanted to give European member states a possibility to move coherently. But some countries, either for financial requirement and for political stress, moved a little bit forward. Notwithstanding the directive are still pending. For instance, the Italian states enacted an internal web tax, which is more or less similar to the directive one. There are some problems on this process because, first, you cannot guarantee integrity. If you don't move under the umbrella of a directive, you have difficulties in interpreting an internal law. For instance, in our law, there is no definition of subject to tax. There is no definition of the group. There is no definition of the fact that all the the user's data are important for the rule, even though this user does not cause directly the revenue subject to tax, which is a specific provision contained in the directive and is missing in our internal rule. We are not defining what is the digital interface. We are not defined how do we calculate revenue, which have to be taxed with the 3%. We don't know if the revenues accrue on a cash basis or on an accrual basis. We don't know how to consider the consideration in kind, which is in the digital world are the normality, are not the exception. The allocation key. Let me just do one example. The directive taxed the utilization of a digital platform in order to buy services. As I said, e-commerce is excluded. What is it has to be taxed is the intermediation fee relating to this sale. So through a web platform, I rent a house, let's say in Spain, and since the Italian rule says that you have to tax in Italy on the revenues from this intermediation on the basis of the percentage of transactions concluded with at least one Italian party, it is clear that you have to tax, let's say that that company makes only that transaction, 100% of that income has to be taxed in Italy with the 3%. But what about Spain? If Spain adopts the same mechanism of the directive, which says on the basis of the percentage of the users that conclude contracts, well, in this case, the percentage of the user that conclude contract in Spain is 50% because one user is in Italy and the other user is in Spain. So also Spain has the right to tax 50% of that revenue. So as you can see, double taxation is concrete. In addition, double taxation is per se existing for Italian companies or member state company which implement the directive, because you cannot credit the tax from the corporate income tax, but maybe you can deduct it. This is done in order to be compatible with the double tax treaty, but at the end of the day, it results in double taxation because an Italian company which provides services through digital platforms will be taxed on the same income because that group does not have any other income other than one already declared to the Italian tax authorities. And notwithstanding that, you have to tax it with corporate tax and with the digital service tax. In addition, the e-commerce is still outside, and this is another issue. I will come back in the conclusion. Last is unilateral, and this is my first worry. When you basically introduce unilateral provision, you conflict with the aim of the directive. The EU wanted to give rise to the two directive proposals in order to go forward to the single digital market aim, which is one of the aim of the policy in this moment. And at the moment each country starts to anticipate this, of course, this objective will not be met. Finally, it will be more difficult for Italy or other country singly to go and face, for instance, the United States, that certainly will react to this type of innovation in the tax system. And it would be much more different, I guess, if the EU will sit instead of the single member states with the US in order to negotiate a better design of the complex of this complex matter. I will stop now for a moment.
Thank you very, very much indeed, Alberto. Very interesting and current expose of a difficult situation. I certainly am very much aware that the sums of money absolutely monstrous. And one way or another, if we don't get resolution in one way, then there are going to be many member states seek to get resolution in another way to get revenue in, and you know, how that's going to end, I honestly don't know. I sent round a note, if anybody has got any questions they want answered, if they could put that on chat, if we can deal with it today, if we've got time, which is unlikely, but if we can, we will. If we don't deal with it, then we'll deal with it online when we post this webinar so people can download it. But Alberto, thank you very much indeed. And I think now we'll go straight over to Philippa and to look at the, if you like, the client side of it, the sharp end. Philippa, over to you.
Thank you, Ian. Thank you very much. So I will, after Alberto's presentation, focusing on the context and the tax frame redesign and the opportunity of redesigning it, I will focus, my aim is to focus on the impact that tax digitalization has on businesses and CFOs. So the digital transformation is having a wide-ranging impact on business environment, and it of course creates opportunities and challenges. There is a continuous change and innovation, and this is what we would say now the new normal. Everything is digital. So even this pandemic event put some further pressure on the digitalization, and the number shows that business that grew more were those that are in fact digitalized. So the COVID-19 revealed even more the importance of technology during such period, and we assisted to a massive use of video conference, digital collaboration, a boom on e-commerce, and even an increased concern with cybersecurity. On the side of the tax administration, there is even more pressure on revenue collection and securing revenue in the context that governments everywhere in the world had to launch specific incentives to minimize the impacts of the pandemic event. So we had, as Alberto described, a scenario in which we had already revenue that, due to the existing tax rules, were escaping taxation, and countries were struggling. And with the COVID-19, the pandemic event, this situation, there is even more pressure. With all this in mind, within this digitalized framework, I'm truly convinced that the CFO's role has been never more dynamic or different, and I would dare to say even so strategic. And why? Today I will try to give you just a hint on why I think that it's so strategic. In terms of tax implications of the digitalization, and besides the impact on digitalization on the international tax rules that were already covered very sharply by Alberto, and this need to reach this global consensus and avoid unilateral measures by individual countries, which of course will entail risks, as we know, and increased burden that we want to avoid. Besides this redesign that we are currently carrying out, trying to reach a consensus, there are other impacts of digitalization on taxation that should be referred. And Ian referred this in the beginning, in the introduction. There is automation and digitalization also from the tax authority side worldwide. The tax administrations everywhere in the world are making steps towards being more digital. And this is something that we should be well aware. Not all countries are in the same stage of automation, but there's a trend to invest in technology and become more digital, to be more efficient, to make sure that less revenue escape to taxation, to cross-check data, to be more close to taxpayers. So there are several motivations by tax authorities worldwide to go in this sense. So to give you an idea, there are several levels, as I mentioned, of digital automation from tax authorities. There are 5 levels, let's put it this way. One would be the so-called e-file, with those tax administrations that use standardized electronic forms for filing tax returns, etc. Then we have a second level, the e-accounting, in which it is characterized by the need of submitting accounting or other source of data to support filings in a specific electronic format. It is the case, for example, of the electronic invoicing in Italy. And thinking of the electronic invoicing and on the side of business, what we see is that it might seem easy if we think in a context, in a single context, in the context of Italy. But we need to think that the businesses nowadays are global, are globalized. So groups are very integrated. And there are several cases, or the majority of cases, in which we have even, for example, centralized accounting systems. How business can deal with electronic invoicing and coordinate, match the needs of the Italian requirements with the global system. This is something that needs coordination. This investment is something that has a digital impact in practical terms for businesses. Back to the levels. Level 3, there's an e-match, a so-called e-match. An example is, for example, Portugal, where tax administration is able to cross data. And you can see here there is more power from this, more information. We are reaching levels more and more in which tax administrations have more access to data. Level 4 e-audit, tax administration can cross-check to filings in real time, and then taxpayers have less short time to reply. It's the case of Russia. And you can see, again, from the side of businesses, consider that companies need to have the data ready to react promptly. So is a challenge, is a digital challenge. Then level 5, e-assess, and here we find only Spain, in which tax administrations have even more power to use submitted data to assess tax without the need for tax forms. And then taxpayers have limited time to audit the government's calculated tax. So you see that from the tax administration's side, technology is expanding in different ways. From here, what we can experience, what we fear, is that there are several potential risks that might also arise from the fact that tax administrations are becoming more automated. And it's important that tax administrations are also well aware of these risks and take some steps to minimize it. And this, from the side of business, of taxpayers, I think it's important to safeguard the taxpayer rights. And to list some of the risks, think about maintaining the privacy of taxpayer data, the storage. Tax administrations worldwide have much more information now. How is this information secure, stored? Cybersecurity and the protection of personal data. it's frequently in the news. Unfortunately, you can see that cyber attacks increase exponentially in the last couple of years. And then also the use of data analytics, especially when subcontracted to private sector. These are really real risks that we should be aware and try to counteract, try to agree on a proper safeguards and controls. So CFOs and business are not, by saying this, I'm not saying that businesses or CFOs are against this automation from the side of tax authorities, no. But CFOs and C-suites and businesses are concerned with the right level of protection with regards to the implementation of the right set of data protection rules and controls from tax authorities. So a sort of minimum agreed standards in this field would be most welcome. Personal data and privacy needs to be a standard in this automated digital framework. With regard to cyber attacks, of course, CFOs would pretty much appreciate that tax authorities have the necessary technology and protection to secure and limited the risk of cyber attacks, although we know that more and more these kind of attacks are even more difficult to tackle. So in our view, we think that proper attention should be devoted to what are the best means of security, how and well it will be stored, who will have access, how confidentiality and privilege can be preserved. And the main point of concern is safeguard the taxpayer rights in a proper manner. So digitalization should be coupled with a series of protections, and we know that we are all pressed to automate, digitalize first, but we need to be sure that the framework that we put in place does not entail in further risks. So how we foresee that the new rules in the digital field may affect companies. The new rules will affect the new rules in the digital tax framework. So the new rules will affect the business models, as Alberto explained, in any company with cross-border business. And this is what we already are seeing. We will need a kind of assess and adjust exercise to be sure that business do not entail and potential risks in potential reputational issues with regards the improper use of the rules. Another point is the uncertainty on the digital tax standards side, which contribute, of course, to which prevent the uncertainty might compromise the way business can make sound business judgments. It would be better for business to focus on the business side, on growth and development, to have a clear set of rules and consistent as much as possible. As Alberto said, the OECD recommendations are not binding, and as such, they might defer the implementation of the OECD or EU recommendations. This new set of rules might differ among countries, so we expect disputes, and the best outcome would be to find this consistency in order to avoid the double taxation that Alberto explained, and reach this common and avoid a patchwork of rules, of course. So in this digitalized scenario, tax must be for sure in the boardroom. Companies need to have a clear picture around the company data sources and quality, the content shared digital to tax authorities worldwide, have oversight and control, and ignoring it and not taking action could lead to risks of increased audits, increased tax penalties, with pretty much reputational and operational risks. So the risks associated with the digitalization of tax enforcement might even lead to increased audit activity and increased notice. And this is something that we need to be well aware. Another question for businesses to take into consideration is within this new complex tax framework, are business preparing for a sound defense strategy? We see that tax automation grants more access to data also to tax authorities. So is the company prepared to defend in an efficient way, prepare for digital reporting and efficient digital reporting? In terms, so this gives you an overview of the impact of the digitalization, on the need of the digitalization of companies. Companies need also to invest more on the proper set of tools to be at the same pace of tax authorities and monitor the developments in order to be able to meet the requirements that are needed. So within this new context, the tax function and the role of the CFOs and C-suites shifts from being mostly a compliance function to a high value and reporting function. In IFA, we are well aware of this paradigm, and this is why we are preparing a CFO declaration that goes into this direction. Identifies 7 key areas in which the CFO can drive change and enhance value within this organization. And within this 7 key areas, 2 or 3, let's put it this way, are focused mainly devoted to tax digitalization or tax automation matters. Briefly, I know that we are almost without time, Ian. The 7 key areas, I will just list it very briefly. Tax in the boardroom, of course, the importance of the key role of the CFO in the modern board in this framework of increased transparency and compliance to ensure the consistency also, and being aware of the power of data and data consistency, the role of the CFO for the company's performance, and technology leader. The CFO should be in control of companies' data, be ready to do an integration of systems, of invest on IT, digital transformation, the 4th, 5, integrated reported, 6, ethics and sustainability, and finally, the role of CFO in the context to ensure an efficient communication with stakeholders. So, to sum up, to conclude, boards need to keep well informed with tax automation, digitalization of tax authorities, and also the changes on the digital tax rules. Need to understand and monitor the data requirements of the tax authorities in each of their operating jurisdictions. Avail themselves of the appropriate tools to prepare digital tax submissions efficiently. Be ready to sensitize data for tax purposes, check for errors before filing, and prepare for shorter deadlines to provide data. And what we see is that an amazing pressure also from the side of businesses that requires a change in the mindset, an attitude with regards to digitalization. It needs to change from a reactive mode, more local focus, compliance focus, many manual or Excel centered, and which is more risk prone, to a really proactive mode, which is more centralized, more integrated, standardized, even with, if possible, with tested with analytics, which will be more in control of data. So the clock is ticking, and I think that in this globalized, digitalized economy, digitalization in practice is happening, and we should be well aware, either from the being the tax advisors, the businesses, or tax policy governments and institutions. We should all be well aware of the impact and prepare for the changes ahead if we want to succeed. Thank you, Ian. Over to you.
Thank you very much. Now, I've got a bit of an echo. We've almost run out of time. Putting up on screen the key points, I think, that we would like taken away. We haven't got any time to do all the questions here, but what I would like to do is just ask Alberto two very quick questions. One, how likely is it that the Italian revenue will bring in the web tax? And two, if he could just have a very quick summary of what he thinks the next steps on that will be in Italy, which I...
Thanks, Jan. Unfortunately, it has already been done. Last year we had a provisional, let's say, rule, but this year it entered into force. So we still lack of clarification, but formally, from the 1st January of this year, the Italian web tax is a reality. Future steps, I do believe, as I said before, member states that move in a single way, isolated from the EU, it's a big mistake. I think the focus should be at the international level for providing a new form of taxation of digital multinational, and only at that level we can think about renegotiate the double tax treaty. We need strength, and maybe Europe can help in this time to all the member states in order to renegotiate double tax treaty. Maybe one could also think about putting in place a multilateral instrument similar to the MLI put in place by the OECD. Single country can only do one thing, in my opinion: reduce competition discrimination with local provision. In this sense, for instance, you can rethink about increasing tax aid for physical, for instance, presence in Italy. Also for physical commerce. As I said before, no one provision interacted with the e-commerce, but it's clear that there is I don't want to say unfair competition, but there is competition between physical commercial activities in the States and web commercial activity outside the States. And now the web is utilized for several functions. And so I'm not sure whether the conclusion of the OECD in the beginning of the 2000 are still correct when they say that the web will never be a PE because the presence is very minimal. For instance, one can think about giving an ultra deduction of depreciation, amortization of physical goods in the member states. Then you can reduce the tax wage on labor income, so increasing the labor force in the country. Then you can, for instance, think about flat tax for people who rent physical commercial shops to commercial activities. In other words, to conclude with an image, I think also the e-commerce might be an issue in the digital economy from a tax standpoint, in order to avoid to finish everybody living in the city mentioned in the last Rolling Stones song, which is the cost city. We have been seeing similar approach during the COVID, unfortunately, and we all see how sad it is to walk in our cities with no shops, no lights, and no security. So I want to conclude saying that sometimes web tax might also be seen with a social, let's say, aim.
Okay. Well, thank you very much, Filippa. Thank you very much, Alberto. And thank you all very much, the attendees. I hope you've learned something today or to take away. And we'll be back again in about a month's time with another one of these webinars, which we're getting quite used to doing. So I say bye-bye. Thank you.
Thank you very much, Ian. Thank you.
Thank you. Ciao.
Bye-bye.